In this video, we will be discussing the importance of fundamentals versus technicals. We will also be discussing how this relates to developing algorithmic trading strategies. If you find this type of content interesting or useful, please like and subscribe to the channel so that you never miss an update. Okay, so really a common debate amongst traders is often the importance of fundamental versus technical analysis. And quite often when listening to traders in podcasts or in reading books about them, you will hear some traders refer to themselves as technical traders and some referring to themselves as fundamental-based traders. And quite a few long-term investors are also typically more fundamentally driven versus technically. So the goal of this video is to discuss what are the advantages or the use cases for both of these analysis methods when developing trading robots. So first of all, what can you define technical analysis as? Because I find that the perception of technical analysis is quite often a simplistic version of it. People think that technical analysis is purely drawing lines on a chart, but there's so much more than just that. So here the definition is: technical analysis is a method of evaluating statistical trends in trading activity, typically involving price movement and volume. It is used to identify trading and investment opportunities. And how I would typically simplify that is simply saying technical analysis is using market data to predict future price. So this could be either using price to predict price, using volume, or any of the nuances of market data. So in particular, when you get into the futures markets or into any sort of publicly traded or like exchange traded asset, you all of a sudden get order book data, you get liquidity data, and you get so much more information from the exchange. And using this data to predict price would be some form of technical analysis. So most quantitative analysis, such as like market making or order book analyses done by some of the largest quant firms in the world, I would classify that also as some form of technical analysis, because ultimately you are using price and market data to get some sort of predictive edge. So that's perhaps a good starting point. And here you can see a picture of Mr. Eugene Fama, and he was one of the big creators of the efficient market hypothesis. And there's different levels of the efficient market hypothesis, but the first one is that past price has no predictive power on future price. And this was kind of one of the biggest knocks against technical analysis for a long time, because people felt that based on the efficient market hypothesis and based on his research, that there would be no predictive power behind technical analysis. But I think you can talk to any trader, and I think most modern research would also contradict this general hypothesis, because the most famous example is Renaissance Technologies, which averaged 66% annual returns over a 30-year period using quantitative trading systems. And yes, they are using very sophisticated math, but a good chunk of that is based on market data. Therefore, if they're using market data to predict price, then and they're having such fundamentally awesome returns over a large period of time, price must have a predictive power on predicting price. And if you've been trading for any amount of time and you've developed trading systems, you know that you've been able to develop systems with an edge off of price data. Therefore, the efficient market hypothesis can simply not be perfectly true. And there are, like, at least for our cases, there's definitely an edge coming from technical analysis. We can now move on to fundamental analysis. So this is a long definition, so I won't read it out loud, but this is more of an equity-specific definition, but it comes down to using fundamental data, be it in the case of equities, company data, or in the case of more commodities and currencies, economic, macro, and micro factors, to essentially assess the value of an asset and then predict its security price based on that. So the most classic example here would be value investing with the Warren Buffetts and the late Charlie Munger, where they would say like, hey, we think based on the company's balance sheet, it should be worth X. And if we kind of derive the stock price from that, it's either overvalued or undervalued, and we will make an investment decision based on that. And I primarily trade commodities, so gold mostly. And with gold, you could, for instance, look at more the macro factors affecting the price of gold. So the economic volatility, interest rates, and for many commodities, less so for gold, also the production factors relative to that. So in the case of oil or natural gas, for instance, if you monitor like inventories of oil and new fields coming online or new natural gas wells, weather data, that has a huge impact on certain commodity prices. So ultimately, fundamentals are using real-world non-market data to predict price versus technicals are using market data to predict price. So the magic question here is which is better? And a great way of thinking about this, I actually learned from a course on Udacity by Tucker Balch, I think is his name. And he is a former MD at JP Morgan, and he actually taught a great course in algo trading, which I would recommend you guys check out. But he really gave this toy example, which I found super useful. Like, I would invite you to ask yourself this question. Like, on an average 5-second period, what really changes fundamentally about the gold markets? Like, not much. I'm just like, sure, maybe during your CPI event, yes, a lot changes over 5 seconds, but over like your average 5-second period, like 2 a.m. on Tuesday, what happens? Really not a ton. It isn't like every 5-second period a new mine is coming online or there's a huge interest rate announcement. That being said, price moves over that 5-second period. So what is causing price to move if fundamentally nothing really has changed? And that's really the auction process of the market. Buyers and sellers are causing price to move over that 5-second period. And this can be extrapolated down to most shorter time frames where you can say, hey, price moves over short time frames despite not a ton happening fundamentally. What is causing these short-term price fluctuations? Really, it's the market in and of itself. Therefore, analyses techniques which are based on the market, such as technical analysis, would therefore make a lot of sense over these shorter time periods. On the other hand, you can look at it on the average 5-month period, what changes in the gold markets. And obviously the answer here is a lot, right? Like new mines can be built, or like interest rates can change, wars can be started, massive changes can happen fundamentally. So is using a support and resistance really that helpful over a 6-month period? I would personally say no, not really. Like, yes, there may be some supply and demand factors which can help you, but the main movers over these long time frames are going to be fundamental factors. So really here, like, what are the practical applications of technical analysis given these findings? And really, like, I would say technical analysis should be the backbone of any trading robot, because trading robots typically don't swing trade. Like, some do, but it's very unlikely that you would have much of an edge purely technically over long periods of time. And that's why I would be like, I have yet to find a trading robot which trades more on a fundamental swing trading style. And technical analysis in a robot would therefore inform your entry, your exits, so triggers, as well as your filters. And this would effectively tell you, like, it would serve as the backbone of your trading strategy. However, where fundamental analysis can be very useful is it can be used as a filter. The most obvious example here are news filters saying, hey, there's going to be significant volatility during a CPI announcement, perhaps don't trade. However, you can also use it more as a market regime filter. And I have another video on market regimes, but effectively what this means is certain robots will trade better during bullish markets, during bearish markets, or during choppy markets or range-bound markets. And using fundamentals can actually really help you assess when to trade which robot. So it can be fantastic when running more of a portfolio of robots. So that'll be a wrap for this video today, but I'd encourage you guys to go check out our WAP page linked in the description, where you can get a free trial of any of our robots to improve your trading strategies. Thank you very much. Take care.